Welcome to the Gray Report. I'm your host, Spencer Gray. And if you are a multifamily investor, I'm an aspiring investor, an industry insider, well, we have a great show for you today on the Gray Report, doing another recap of everything that happened in commercial real estate, and the economy. But if you're not subscribed to the Gray Capital YouTube channel, which is the home of the Gray Report, all of our weekly recaps, all of our podcasts, all of our education content, you want to make sure that you subscribe to this YouTube channel, the Gray Capital LLC YouTube channel. And if you're not receiving the Gray Report newsletters that come out every Thursday morning at 8:30, you're going to want to hop over to graycapitalllc.com/newsletter to make sure you're signed up, and always hop on over to grayreport.com to stay up to date with daily updates from the multifamily industry, real estate, and the economy. Well, we had an incredible week this week. We have Matt Bosnagel, the Director of Communications and Marketing from Gray Capital, with us again, bringing us through what happened, kind of keeping us, again, up to speed, getting the best information to be able to make the best financial decisions. And it's been an incredible summer so far, a crazy year, 2021. We've got a lot of topics, a lot of the same themes, but we've got some incredible developments and some breaking news that just came across the wire. As we're recording this at about 8:45 Thursday morning. The newsletter came out at 8:30. We just had some news come over from the BLS, the Department of Labor. Just came across from the Department of Labor and Statistics, showing what CPI data looks like. But let's bring Matt Bosnagel in. Matt, how you doing? Let's bring Matt Bosnagel in. How you doing today, Matt?
Doing pretty well. How about you? Well, I can tell you're doing well, so that's nice.
I'm trying to. I've been out on location, on vacation in Mexico, having a good time. But luckily, GrayReport.com has been keeping me up to speed. So I'm just very grateful we've got that resource out there. So let's just hop right into what's going on in the Gray Report, what you would have seen if you subscribe to the newsletter. So again, Matt, early summer heat, what's been going on? Things have been heating up. Buyers, investors, renters, inflation. What's happening?
I'm feeling the heat this week. A lot of market activity. The most recent jobs report showed lower unemployment. Wages are going up, and there's more spending from consumers and governments. In the CRE markets, the improving performance of retail, the continued high-performing industrial sector, and the consistently improving multifamily market have made commercial real estate a really another hot ticket. So it's attracting attention from larger private equity institutions. And in general, really, there's a lot of money, less places to put it, and something's going to happen. I won't say what it is, but I think it's pretty easy to guess.
I think it is for many, but still, I think many are trying to figure that out and have been trying to figure it out. And we're always trying to figure it out. But sometimes it can seem more difficult and the landscape a little bit more unclear. But you've always got people who, think either the cliff is right across, the next bend, or, we're going to the moon.
It's animal spirits. It's my favorite economic term.
Oh yeah. Got the bulls and bears. But quick, just before we get into the report, again, so this report was released at the exact same time that the Gray Report newsletter came out. So it was not included on the newsletter. That's why you have to watch these videos as well to get that nice supplemental piece of information. So on the CPI report, let's just read it real quick, kind of getting into what this is talking about. We're not going to spend too much time on it as we haven't even digested it ourselves. But the consumer price index for all urban consumers, CPI, increased 0.6% in May on a seasonally adjusted basis after rising 0.8% in April. The U.S. Bureau of Labor Statistics reported today over the last 12 months, all items index increased 5% before seasonal adjustments. This was the largest 12-month increase since a 5.4 increase for the period ending August 2008. So long story short, this is the largest month over month and year over year increase for CPI data since 2008. We're seeing the most inflation we've seen really in decades. We've got a nice chart here kind of going back into kind of year over year. What I find interesting on this report is, we still have, price pressures increasing. We're seeing inflation, but this may be some evidence that we're not seeing hyperinflation. The inflation may be more transitory and maybe not going to be just completely overrun. And we're seeing that in Treasury data as well. But just looking at this, we had a 0.8% increase back in April and a 0.6% in May. So we're not continuing to accelerate. We're still at elevated levels. Without a doubt, there is elevated inflation. But if we were seeing some kind of hyperinflation, we would have potentially seen that trend continue to increase. Obviously, we want to see what June's numbers come back. If it boosts up against that 0.8% we saw in April, then we may have some more worry in the cards. But I think this is more evidence to say that this inflation may be more transitory than longstanding. I think it's not going to be it's not a blip, but maybe we don't have to fear hyperinflation. But let's look at what some of the rates and markets, a snapshot on the Gray Report, because I think looking at the U.S. 10-year Treasury yield, it really kind of echoes that. And I think some people, these bond traders, they say, the bond market is the smarter money, smarter market. You can really get a lot of information. 10-year Treasury, cost of capital. It's also, it's a way to forecast inflation. And we did see the 10-year Treasury note dip down below the 1.5% mark. It had been hovering around basically 1.5 all the way to 1.75 over the past several months. We finally dipped below that technical indicator of 1.5%. We quickly rose above that, and just this morning we're seeing it spike back up. I mean, not spike back up. We're at 1.53. Where it had dipped down for not just a really like a 6-hour period, a couple hour period. So not too 10-year Treasury below that 1.5%. SOFR, 30-day LIBOR, we're at 0.07%. SOFR, 0.01%. And the spread between the 10-year Treasury and the 2-year Treasury is clocking in at 1.34%. HUD rates, HUD 223F, coming in at 2.35%, quite low. Those rates have decreased from prior weeks. HUD 221D4 clocking in at 3%. Fannie Mae, again, believe these are usually around 10-year terms, fixed rate loans, but again, these can change depending on the market, the sponsor, the deal, the amount of value. A lot of different variables go into these rates, but these are pretty close averages. Fannie clocking in at 2.7, Freddie clocking in at 2.8%. They both have their different spreads, their different appetites, and their different allocations. iShares Residential REIT. This is a REIT that tracks, large apartment REITs, coming in at $84. The residential REITs have been on fire. REITs in general have been some of the top performers in the stock market as of recent. Again, that stock market is a future indicator of potential economic performance, and has been showing that real estate has been performing very well. Not a big surprise, since real estate is considered to be an excellent hedge against inflation, especially residential real estate. Spot price for gold coming in at $1,889 an ounce. The steel index coming in at $1,840. Lumber, random length futures coming in at $1,158. Crude oil coming in at $69 a barrel. Man, that crude oil price, remember we were at 20s, low 30s, even less last year. Bitcoin, crypto's having some trouble. Bitcoin coming in at $36,712, and Ethereum clocking in at $2,537, and the good old S&P 500, man, still cooking, 4,219. All right, so let's get into the bulk of the Gray Report. We've got more information on supply issues, construction, what's going on in multifamily, the economy. All right, we've got a nice report from Marcus and Millichap on housing. Surging prices, supply shortages have impacts beyond housing segments. And man, I want to bring you in here in just a second, because I want to get your take. I just want to read this first paragraph. We got the second paragraph, and they've got a nice graph showing prices of lumber and gypsum. Gypsum, that's essentially drywall. So prices of lumber, framing going up, drywall going up. Again, these buildings are a combination of a lot of different commodities, a lot of different pieces. But I just want to read this real quick. Higher building costs impact profits. It is estimated that the leap in the prices of building supplies has added roughly $36,000 to the construction of a home and $119 to the monthly rent of a new apartment. Over the past 12 months that ended in April, the median price of a new single-family residence was the residence price vaulted 20.3% to a record of $381,000. That elevated cost and longer construction time frames may limit developers capitalize on high demand, especially if the cost of financing continues to increase. One bright note is that single-family permitting has outpaced the February 2020 level for an eighth consecutive month, although some builders may be delaying construction starts as a way for supply disruptions to ease. Matt, what's going on? I guess it's not are elevated, but the last time we looked at the average median home price, I think it was close to $350,000. Now it's at $380,000. We got new rents coming in for over $120 a month. That's like a 10% increase, essentially for like a rent in the Midwest. $36,000 for a new home. That's crazy. What are your thoughts?
Yeah, I mean, it's the same story, but the numbers are higher. I remember when we were talking about $12,000, like it was a dramatic increase, and now we're up. Now we're up so much more. Yeah, it is the same story, but I mentioned last week that we are starting to hear this different kind of perspective on this, on how people are dealing with material shortages. And this report explains how developers are reacting. The report mentions the potential for builders to stockpile materials, as well as the possibility that builders may shelve lower margin projects for the time being, focusing on industrial, medical office, and single tenant net lease segments for the next few years. The implication then is that these lower margin products are residential and multifamily, which is not great for multifamily.
Well, it cuts both ways, right? It's difficult to develop that limits new supply, with increased demand, increases price for existing properties. So it kind of depends on which side of the fence you're on. But then we've got an article here from Globe Street that kind of provides a kind of like an actual like an example of how a developer is kind of dealing with some of these issues. Kind of take us through how this one investor is mitigating the surge in material costs. This is anecdotal. This is one person, but it's just kind of a real life example.
Yeah, so that was the developer's perspective. They have their decisions to make, and then from an investor perspective, someone that maybe wants to buy a property, there are different developers who are solving these commodity obstacles in different ways. One quote that I think was particularly interesting, because this is something that you mentioned, Spencer, last week, and it really didn't it didn't strike me as interesting. And then I came back and thought about it. It's like, yes, this is actually true. It really could shape the way these buildings are being built for at least the near future, is how in some cases these developers have had to get, the quote here is, in some cases, we've had to get a little creative and substitute other materials, like using steel frames instead of wood, or there are other ways to get around using one particular type of material. We may get some kind of cool buildings and some new ideas that result because of these interesting supply constraints. It's not like they're not making, if the cost is the same for steel and lumber, maybe you make a really great steel building. So it's interesting. It's not it's still problematic, but it's nice to know that there are ways that investors, either through the ways that they choose the developers and their strategy, and the developers themselves are kind of getting past this.
Yeah, absolutely. What is it? The necessities of other invention. I mean, it forces. Why would a builder, as they know how to build a house? They know how to build a part. Why are they going to change the way they're doing things unless they have to, unless they need to? And so now we're being creative, and I think it's a good point. Is it just going to be steel frame instead of wood frame? It's going to be completely different. Just rethinking what, how do we get this done? Or is it going to be so transitory that it's just like a flash in the pan, and there's going to be like a 2-year period where it's like, oh yeah, that building was built in 2021, so it's got steel frame. Maybe that's a good thing. Get that 2021 vintage. That's going to be kind of like a little hidden secret. Out there in the future. Who knows? All right, let's look at what is next on the Gray Report. And let's into liquidity.
Yeah, so you've got higher prices, and you also have more money in the market. I think this is interesting because the supply chain pressures have a particular impact on multifamily that we mentioned before, how developers may be choosing these higher margin products. But on the other side, you're actually seeing more liquidity in the multifamily market than in other sectors. So I don't know if it necessarily cuts both ways, as much as there's a little bit of a cushion in terms of capital out there for multifamily more than any other sector right now.
Yeah, I mean, we've been talking about this. There's a ton of money chasing very few deals, and people just, I think, probably, and I don't think they mentioned this, compared to other asset classes. I imagine that industrial would probably be, number two. So many other asset classes people are just unsure of. Multifamily seems like a pretty sure thing, more or less, and industrial kind of the same, where it at least has the most solid fundamentals in its most solid footing. And so, we saw, and when they say just the most liquid sector, there's the most transactions, the most buyers out there for these types of assets, which bears well for existing multifamily properties. It makes it difficult to purchase a
Yeah.
new property, and then abundance of liquidity. Another article from Globe Street. Basically, just talking about how much money is out there, and there is an incredible amount of capital sitting on the sidelines. There's just a
Yeah.
ton of money, not enough deals.
Yeah, it's I like the quote from that article. It says, even distressed and special situation borrowers can often find the necessary capital to complete deals thanks to a plethora of funds lined up for this very purpose. It seems like no matter what you're selling, you'll probably find a buyer for it. There's so much money ready to be deployed. And then
which means buyer beware, because that means that there's people who are unloading their, not garbage, but they're unloading their less desirable assets.
And that's a really good point, I think. And I also wanted to note that the Commercial Observer article that talks about this looming threat of huge private institutions entering in the market with big private equity firms. And I know that it's kind of a common phobia for small to medium-sized apartment buyers that this huge investor rolls in that says, I've got $1 billion, and this is actually the start of the article, which is kind of fun. I've got $1 billion and I need somewhere to spend it. It always sends chills down your spine about these people that are willing to accept these lower returns because they just have so much money sitting somewhere that needs to be deployed. I would put a small qualifier on that, because the Commercial Observer article notes that these institutional investors are waiting for the right conditions. And that leads me to believe that this may not be this enormous looming threat that it's portrayed to be. If you're waiting for deals, that may mean that you might miss opportunities, versus if you're pursuing deals and searching out new markets and opportunities more actively. They're waiting for their numbers to, it seems like, line up exactly how it is. And I just don't see that as this enormous threat of they're not making things happen. They're really kind of trying to wait for the planets to align correctly.
Mm-hmm. Well, I think that they've been trying to do that for the past year, right? I mean, and I think a lot of this was that during the recession, they were saying that, okay, I've got this money, I'm ready to go. As soon as everyone was like, they were thinking back, everyone was thinking that they were going to be really smart, and they were like, I'm getting ready to go on a buying spree when these prices drop. And everyone's like, well, I'm ready to go, which the only way that prices drop is like if confidence decreases. Mm-hmm. But like if everyone's ready to buy something, there's buyers lining up. That's not a lack of confidence. That's an abundance of confidence. Yeah. And so now they're sitting here. They're like, we missed out on a year. Prices, actually, the COVID pricing was just the same nominal price value as 2019, 2020 prices. It's just that we didn't realize that the value of the dollar was decreasing so fast. Well, I mean, some groups did. I mean, I feel like we kind of saw, we didn't see the future or anything, but we kind of saw what was happening. And if the opportunity was when things were on fire, and prices didn't decrease, but if anything, that was an indicator of, wait, we're going through a global pandemic and prices are stable. There are still transactions occurring. That is a show of strength if I've ever seen one. I mean, we saw price decreases in other markets and other asset classes, but not necessarily in apartments, especially where we're buying apartments. And I'm trying to find the exact number in this article, but I think there's something mentions that, specifically commercial real estate private equity firms have around $380 billion.
Yeah, that's what. 387 ready or something like that. Yeah.
And that's just commercial real estate private equity. That's not the sovereign wealth funds. That's not the pension funds. They're all needing. There's this. This was a problem prior to the pandemic of needing yield. With the population's getting older, they need fixed income products to be able to live off of, to support their retirement. or would support pensions. And yields have just continued to decrease for, well, I mean, really past 100 years with the blip up in the 70s and early 80s. But we've had these compressing yields, this search for yields. Where are we going to find it? How are we going to get some kind of income? That's where I think, again, we're seeing treasuries get beat up, and where are they going to put it? And there's just not the deals. So
Yeah.
All right, let's keep on moving.
Just one more ingredient into the current environment for sure.
Absolutely. Okay, so macroeconomic news. Deutsche Bank warns of global time bomb coming due to rising inflation. Why do people say time bombs? And well, I know why, but let's talk about what Deutsche Bank is saying. They kind of have an out of consensus forecast talking about warning of potential crisis coming from inflation. Matt, I think we were ringing the alarm bell way earlier this year. We got a video on it about basically you need to protect yourself now, because if you are just allocated to dollars, you've got a salary, you're going to be left behind as inflation picks up. But kind of break it down. What's Deutsche Bank ringing the alarm bell from? And do we trust Deutsche Bank anymore? They've gotten in a lot of trouble, I feel like, the past couple decades. But oh well.
Yeah, I think that the recent CPI numbers that you just talked about kind of softens the blow a little bit. But I think that it was dramatic, and it did really drive the news cycle for the past week. I know Janet Yellen made some comments earlier in the week along the lines of interest rates should be raised, but the Deutsche Bank comments quickly followed those, and it's really put inflation on people's minds. I know, part of inflation are these animal spirits or whatever the psychology of the market is. So it's not necessarily completely logical. But I do think that the Deutsche Bank comments are a little bit overblown in light of the CPI numbers. It's not going to be necessarily catastrophic, but I think it's something.
They're really talking about how it's for like lower wage earners and people who are the kind of the bottom couple brackets on the income spectrum. They're the ones that are going to be left behind. And this is exactly what we've talked about. A lot of people talk about is inflation. It's the hidden tax, and it destroys currencies, and it hurts those who need the help the most. And that's where the unintended consequences of government spending often, or money printing, is we're going to print some money to create these government programs to help people, but by doing that, we're going to basically rob you through an invisible tax of decreasing your purchasing power. But it's not called a tax. It's not going to show up. You're not going to get a bill for it. But all of a sudden, you had $20 that could have bought, food for a day. Now all of a sudden it doesn't anymore. You have $25 or $30 to, move food on the table that day.
And I think that's that kind of leads in a little bit to the couple of articles that are in the newsletter about this labor shortage and the wage increases that we saw in last month's jobs report. I think that it does seem to be building to something. I think that may be the real missing piece before really people kind of recognize that, okay, this is a true inflationary environment. Wages are increasing, because right now the story about these wage increases seems to kind of be limited a little bit to the retail sector. But I have a feeling that that's going to spread. It seems like, that Market Watch article that happened earlier this week talked about how yes, there are more job openings than ever, and more workers are quitting their current jobs than ever before. So, a lot of jobs, fewer applicants. That means wages are probably going to raise. And
have you seen those like memes and just it's anecdotal, but restaurants, stores, basically putting like signs out who are like, they're closing down, saying, we just don't have this, we don't have the employees to staff today. And like, as soon as we hire any more people, we'll open up. And it sounds like it's mostly mom and pop stores. It seems like it's really just they're bent out of frustration. And a lot of it is probably they're trying to hire for wages, 2019, 2020 wages. And again, that ship sailed. And then it
is, honestly, I kept thinking about this. A lot of this has to be a business plan problem. And they're hiring for those wages, and they're saying they got to close down, but at some point the prices are going to go up. The prices for a
Yep.
sandwich are going to be higher. You may end up spending $15 to go out to lunch. It
Yeah,
may
and
not be
we're not
7 or
talking
10.
about like a nice, corned beef sandwich or a nice Hogs and Hop steak sandwich. But
Yeah.
it's I agree, because again, these owners are going to be like, okay, well, I can't operate. Okay, well, I have to hire people. Yeah, my sandwiches are $10. Now they're going to have to be $15,
Yeah.
$16, $20, and everyone's going to freak
And
out. But then it's like, where else are you going to get a sandwich for less?
well, and I was saying,
What are you gonna do?
if they want to make this move right now when there's pent up demand and where people are hungry for these options, I think that it seems like a very nice time to kind of
Mm-hmm.
to get this started. But that's just one sector. I
Yeah.
think that once we see these wages spread through the economy generally, once we do, or if we do, then maybe this talk about inflation might get a little bit more stronger. We might see really higher CPI numbers.
Agreed, 100%. I mean, we saw it. I mean, if it's in housing, it's in food. It's only a matter of time. People are going to, demand higher wages, and if not, there's going to be a lot of upset employees. And
I do want to mention it, and this is just something that it's just a personal experience. The past 3 days, I was looking at the Google News economy section, and for 3 straight days, it was almost all inflation stories. And it was that and articles about Loki Charms, which is a reimagining of the popular cereal with Marvel's Magical Trickster, replacing the Magical Trickster from General Mills. So it was, at least in the economy section of Google News, it was all inflation and then and just a little bit of breakfast cereal.
what could there be a better combination?
Yeah, that's a derailment. But I do. Yeah, it was funny.
Awesome. All right, Matt. New York's tax bills show COVID's lasting damage to real estate. New York's a crazy place, but what's going on? What's this lasting damage that?
Yeah, I think that
tax bills show?
this article really does highlight the huge impact of the pandemic and how much it wiped out the values in the CRE markets. I think that it does provide also like a useful snapshot, because everyone's always looking and predicting, well, retail's going to do better, and a lot of the prices are forward looking, and this article shows that actually, when it comes to property taxes, what they wrote down on their valuations, office values were down 16% and hotel and retail were down 20%. Now that's a little bit off the story that we're now hearing about, declining office and improving retail. But those are big numbers no matter how you slice it.
Yeah, I agree. And it's sometimes, New York, I feel like, can be on the leading edge of trends. Then it's also kind of all on its own. It's kind of its own animal too. And sometimes it's difficult to kind of figure out, where that is. And I think that New York is a little bit, I mean, I think it tells a story of a lot of the gateway markets, like we've discussed.
Yeah.
But it's definitely an interesting story to say the least. Okay, so then Matt, there was a really interesting article, and again, we're kind of into the commercial rent, multifamily trends and technology, and where did we build this last decade? Because everyone's like, we don't have enough houses, so where did we build? And I thought this was a really good, an apartment list. Apartment list puts out a lot of really good data, a lot of really good information.
Yeah.
And you can get sent the stuff straight to your inbox. If you sign up for the Great Report newsletter, greatcapitalllc.com/newsletter. It says, nationally, about 9 million homes were built since 2010, growing the total market by 6.9%. But it varies depending on which metros, which part of the country, and we can tell that's really probably hasn't been enough. North Dakota, Utah, Texas lead the pack for new housing construction. And again, I recommend going through this entire report because we're not going to have time to get into every single piece. But one, fastest and slowest housing growth for 2020, 2020. Utah, Austin, Texas, Raleigh, Boise, Houston, Nashville, Charleston, Des Moines, McAllen, Texas, Dallas, Texas. Those aren't huge surprisers. But then, the slowest growth in housing, The absolute slowest was Cleveland, followed by Dayton, followed by Toledo, followed by Akron, and that's where when people they categorize a lot of the Midwest as Rust Belt, and a lot of it is, but not every Midwestern market is the same.
Yeah.
And while Dayton I think has come back a little bit recently, a lot of a lot of those Rust Belt kind of Ohio Midwestern markets that I wouldn't be as nearly excited to go into compared to Indianapolis or
Yeah,
Louisville
and
or
that kind of leads in a little bit. Well, so there was an article on the Florida and Sun Belt markets that was earlier in the report, and it just makes me think of a reimagining of the popular cereal with Marvel's Magical Trickster replacing the Magical Trickster from General Mills. So it was, at least in the economy section of Google News, it was all inflation and then and just a little bit of breakfast cereal.
What could there be a better combination?
Yeah, that's a derailment. But I do. Yeah, it was funny.
Awesome. All right, Matt. New York's tax bills show COVID's lasting damage to real estate. New York's a crazy place, but what's going on? What's this lasting damage?
Yeah, I think that this article really does highlight the huge impact of the pandemic and how much it wiped out the values in the CRE markets. I think that it does provide also like a useful snapshot, because everyone's always looking and predicting, well, retail's going to do better, and a lot of the prices are forward looking, and this this article shows that actually, when it comes to property taxes, what they wrote down on their valuations, office values were down 16% and hotel and retail were down 20%. Now that's a little bit off the story that we're now hearing about, declining office and improving retail. But those are big numbers no matter how you slice it.
Yeah, I agree. And it's sometimes, New York, I feel like, can be on the leading edge of trends. Then it's also kind of all on its own. It's kind of its own animal too. And sometimes it's difficult to kind of figure out, where that is. And I think that New York is a little bit, I think it tells a story of a lot of the gateway markets, like we've discussed.
Yeah.
But it's definitely an interesting story to say the least. Okay, so then Matt, there was a really interesting article, and again, we're kind of into the commercial rent, multifamily trends and technology, and where did we build this last decade? Because everyone's like, we don't have enough houses, so where did we build? And I thought this was a really good, an apartment list. Apartment list puts out a lot of really good data, a lot of really good information.
Yeah.
And you can get sent the stuff straight to your inbox. If you sign up for the Great Report newsletter, greatcapitalllc.com/newsletter. It says, nationally, about 9 million homes were built since 2010, growing the total market by 6.9%. But it varies depending on which metros, which part of the country, and we can tell that's really probably hasn't been enough. North Dakota, Utah, Texas lead the pack for new housing construction. And again, I recommend going through this entire report because we're not going to have time to get into every single piece. But one, fastest and slowest housing growth for 2020, 2020. Utah, Austin, Texas, Raleigh, Boise, Houston, Nashville, Charleston, Des Moines, McAllen, Texas, Dallas, Texas. Those aren't huge surprisers. But then, the slowest growth in housing, the absolute slowest was Cleveland, followed by Dayton, followed by Toledo, followed by Akron. And that's where, when people, they categorize a lot of the Midwest as Rust Belt, and a lot of it is, but not every Midwestern market is the same.
Yeah.
And while Dayton I think has come back a little bit recently, a lot of those Rust Belt kind of Ohio Midwestern markets that I wouldn't be as nearly excited to go into compared to Indianapolis or
yeah, and that kind of leads in a little bit. Well, so there was an article on the Florida and Sun Belt markets that was earlier in the report, and it just makes me think about how, yes, the amount of housing that's built is kind of a product of the demand, but it's also of the investor demand. And you want to look at some place that doesn't have a whole lot of supply, or an oversupply. But I also think that, if the focus is on one area that pulls away from others, there's opportunities that might emerge in those markets that escape investor attention. The Sun Belt is growing, but I don't think it's the only place out there. I don't think you have to invest in a shrinking town, but I definitely think that there are places where maybe it's not going to be an oversupply. Maybe the investors haven't noticed it, and maybe there's real opportunities there.
Yeah. Yeah. No, I think it's, there's the kind of the boom towns that are real growing fast, but you can kind of get over your skis. But like, if you've got a long-term plan, you can make a lot of really good decisions or like good investments. But then there's these more like linear markets that are just, steady growth, even some like accelerated growth. But you might be able to get a little bit better pricing, better cash flow. And again, it all depends on what you're interested in. And then I thought this was interesting, and again, this is not surprising. Many metros are building homes faster in suburban regions. Not surprising at all. Dallas building in the suburbs, Houston, same thing. Richmond, Virginia, Indianapolis, again, our home base, not surprising at all, where, the Hamilton and Boone counties are the fastest growing. I mean, it's really the donut counties in general, but quite interesting to say the least.
Apartment List has a really good, the way that they have to visualize their information is really nice.
Yeah. All right, Matt. Another reason why wealthy Americans are moving. Why? I mean, again, this is kind of a similar trend. Accelerated of trends. Why are wealthy Americans leaving, wherever they're leaving from?
It looks like a lot of the story is they're going to places where the taxes are a little bit lower. This was a story earlier, and it talked about how wealthy Americans are moving at a higher rate, at a relatively higher rate than they were before, but they're still not as mobile as other segments of the population. But I think it is interesting. They're moving places that are warm, that have good weather, and that have favorable tax conditions. I think that remote work does play a little bit of a role. We did talk about how remote work last week. We talked about a study that showed that remote work was moving people more to the suburbs than necessarily to another city. But there's also work from anywhere, which isn't really touched on. And I think that there are going to be some permanent moves, and there already were some permanent moves from one city to another. And those are really going to have a lasting impact. And I think it's harder to move back once you move to one city to another. So I think that the story's not over when it comes to migration from gateway markets to smaller cities.
I would be curious if if anybody's done a breakdown by age demographics, because I imagine that older millennial, maybe Gen X, younger Gen X, they're the ones that are moving to the suburbs, kind of staying because they probably want to be close to their job. I'm going to be working for another 5, 10, 15, 20 years. But it's probably those older employees, more of the older Gen X's, baby boomers, who are like, you know what, I'm kind of closer to the end of my career. I don't need to be in the office. I can work remote. Like, I've been doing this. I'm a high wage earner. I want to pay less income tax or no income tax, state income tax.
Yeah.
And like, hey, all my buddies are down in Miami or in Texas, wherever. I'm gonna make the move. So my gut tells me that older, wealthier Americans are probably moving, and the kind of mid-age, older millennials, younger Gen X's are kind of staying in their relative market, unless they're just like, I'm moving for another job somewhere else. But to your point, I think that kind of work from anywhere. We see a lot of tech companies doing. I think that'll probably always be a thing. I think we're just going to have more remote workers, but it's not going to be complete. I think a lot of people are still. I'm seeing a lot of like job ads for like we can do work from anywhere, but we prefer you to be local.
And that's something that we didn't have an article that touched on it as much as every single article kind of talks about. There is an article that says that apartment owners attempt to accommodate the work from home lifestyle. There's articles about how apartments have grown one home office bigger over the pandemic. And yes, that one at the end, is one of the reasons why I included it. This hybrid workplace is a cybersecurity nightmare. It's not necessarily that you're going to be jumping into a into a pool of computer viruses when you're working from home, but I think this is a really compelling one that we're starting to get articles that look at the negative impact of work from home. It's not this panacea. It's not this kind of utopia of productivity. It may be more productive, but I think it does represent some real security issues. And I think that the workplace does have enormous value. And we're going to probably see some people jockeying back and forth between the workplace and the home, and companies doing this as well before we see an equilibrium reached. I don't think that the working from home is going to go away, but I think that it's going to be a lot less than it is right now.
Yeah. I mean, look what we're doing right now. I mean, you're at home, I'm in Mexico, and we're technically working. So, it's definitely possible, but at the same time, like, I want to get back in the office because I feel like I can't be fully productive.
It's a lot easier to do these when we're in the office, for sure.
Yeah, that's for sure. All right, Matt, was there anything else that you wanted to touch on the report that we did not get to? Anything big that I glossed over?
Just one thing really quick. And it's not necessarily specifically impacting CRE, but I do think it has an impact on the economy, is that article on the Senate that, and they recently passed a bill that it was one of the most significant bills passed. I'm sorry, we can cut this. Yeah, the Senate approved a massive investment in U.S. tech competitiveness. This article, really, it's a fairly historic bill in terms of how much money they are pouring into things, and it was a bipartisan decision, which is strange in these day and age. But it almost is like a Cold War with China replacing Russia. I think that's a crass oversimplification, and I do not want to make the Chinese government angry with me, but I am a little bit excited about how much boost this can give to sectors that we really can't easily replicate that quickly. If we can't build semiconductors here, and there's a chip shortage, this is a little bit of a government answer to it.
It is. I'm slightly skeptical because, again, it's like too little. Is it too little, too late?
Yeah,
we already have the shortage, and then it's like, the market's going to ramp up production on its own, and or if it needs to, it will in the right places. And does the U.S. Senate really know, like, how much and where, and maybe they have a good idea, but I'm just skeptical of the federal government's ability to, like, forecast the needs of the economy, because they don't understand. None of them are even, like, in business, and so to the idea that they know what to make these macroeconomic decisions, I think, is foolhardy.
Yeah, that's the other angle. It's probably going to be a little bit of a slush fund, but I do think it's interesting that it seems like they're paying attention to, and what really is motivating people is this sense of competition with China, who has a very overbearing, I guess is how I'll characterize it, approach to the economy. And we'll see what happens if this $25 billion, this is what I was thinking last night, it's just going to disappear as soon as it goes out, or if we'll really see maybe some innovation, maybe a local chip manufacturer that helps alleviate these supply issues that we have, or some new technology that comes from it. That's a dream, but
we can acknowledge that the problem exists and the government's trying to find a solution. I hope that they find a good solution. Because $10 billion of it is for the lunar landing program. So I don't know how that's going to help, starve out, the inflation of semiconductors. We're going to create a regional tech hub program, $1 million to a tech hub program. They're going to create a new directorate of technology and innovation at the National Science Foundation. I don't think that's going to make a single new semiconductor. Update filing fee to increase funding for. So they're going to increase fees. So it's more regulation. So that'll certainly spur more development and more development of semiconductors. And And of course, semiconductors widely praise the bill's passage because I'm sure they're going to get money from it.
Yeah.
So, no, again, definitely have a problem. I think it makes sense to build more things in the United States, but the reason why we don't is because sometimes it's better and cheaper to build things
Yeah. Yeah.
elsewhere. Not that we
Mhm.
can't be as self-reliant as possible, but I'm not a big fan of the government telling us how to be self-reliant, because at the end of the day, that's not really making us self-reliant. That's the government telling us to do something, and maybe then we don't do it in the right way. But
Oh yeah, it's definitely not going to be perfect.
call me just in general a skeptic of government intervention, but Senator Majority Leader Chuck Schumer certainly thinks it might be a good idea.
It was bipartisan, which is rare and I think newsworthy.
Absolutely rare and newsworthy and terrifying.
Yeah, that's true.
Anytime the Democrats and Republicans can get together and agree on something, but in a bipartisan way, yeah, start being a little bit worried because it always sounds like a really great thing, but it ends up turning into something that is absolutely horrifying.
Yeah.
I'm hoping this is the exception. All right. Well, this has been an excellent kind of recap, getting everybody up to speed on what's happened in commercial real estate, the economy, real estate in general. And again, so I really appreciate you watching this. If you got a lot out of this video, please subscribe to the Great Capital YouTube channel. That really helps the channel a lot. It helps us a lot. Shows us that you really appreciate it. Really thank you for that. Also, like this video, share it with any friends, colleagues that you think that might get some use out of it. And then also, again, to sign up for the newsletter, you just have to hop over to graycapitalllc.com/newsletter, and you can bookmark grayreport.com to stay up to date with all the things that are going on: commercial real estate, multifamily real estate, and economy. And if you're an individual that says, I want to kind of learn more about how to invest in multifamily apartments, multifamily opportunities, then that next step is to hop on over to graycapitalllc.com and join the Great Capital Investment Club. The Great Capital Investment Club, it's an exclusive group of multifamily investors looking for cash flowing multifamily opportunities. And a part of the club, a few of the benefits is you get an unlimited amount of investment strategy sessions. Essentially, an investment coach and an advisor for real estate that can kind of help you chart a course, kind of figure out where you are, what type of allocations are going to make sense to your portfolio. And we got free webinars, free educational resources, and it's the only way to actually see investment opportunities provided by Great Capital. So I would highly recommend you go on over to graycapitalllc.com, join the club, and check it out. Now, that all being said, none of this in this video that you're seeing is any kind of financial advice. It's not legal advice. It's just opinions, news, entertainment. So always consult your own financial legal advisors before making any financial decision. Matt, again, thank you so much for being on this week's edition of the Gray Report newsletter recap. I'm the host, Spencer Gray, president of Gray Capital, and we are looking forward to sharing what happened next week on Gray Report.